Welcome back to the Ultimate Trading Podcast for beginner traders, where we help you build a foundation in systematic trading and fundamental analysis. You're tuned into the Fundamental Analysis chapter, and today we're closing out this chapter with Tip 30, Understanding Market Sentiment. This episode is packed. We'll go deep into how sentiment works, why it's critical, the tools to measure it, a case study from the 2020 COVID-19 crash, and actionable strategies you can use in your own trading. By the end, you should have a full appreciation of why sentiment is one of the most powerful, yet often overlooked, tools in a trader's toolkit. Let's start with the basics. Market sentiment is, in essence, the collective attitude of investors toward a particular market or asset. It reflects optimism, pessimism, or neutrality across the market. Think of it as the emotional climate of the market at a given time. Tom Basso, a veteran trader, says it perfectly: sentiment in the market is akin to a heartbeat. It pulses with the underlying emotions of all market participants. Why is this important? Because the markets are not just numbers, charts, or fundamental metrics, they are driven by human behavior. Investors' feelings about economic data, earnings reports, political events, or even rumors influence whether they buy, sell, or hold. And those collective actions create the price movements we see every day. Understanding sentiment gives you a lens into how the crowd is thinking, which often precedes price moves. Sentiment comes in three main types. Bullish sentiment is optimism at work. Investors expect prices to rise, buying is strong, and upward trends often follow. Positive earnings, strong GDP numbers, or favorable policy announcements usually trigger bullish sentiment. Bearish sentiment is the opposite. Fear and pessimism dominate, selling pressure rises, and prices tend to fall. Bearish sentiment appears during economic slowdowns, poor earnings, or geopolitical stress. Then there's neutral sentiment, where investors wait on the sidelines. Prices remain relatively stable as traders await new data or clarity. Understanding these moods isn't just academic, it has real trading implications. Let's break that down. First, sentiment can help you identify trends. When the market is overwhelmingly bullish, following that trend can increase the probability of success. As Linda Raschke notes, understanding market sentiment can make all the difference. Sentiment is a reflection of crowd psychology, and following the crowd during strong trends is usually beneficial. Second, sentiment helps you manage risk. Imagine the market is extremely bearish. If you enter trades blindly, you might be caught in prolonged downward swings. But by reading the mood of the market, you can adjust stop-loss levels, scale in or out of positions, or choose to wait for a better opportunity. Essentially, sentiment acts as a risk management compass, guiding when to be aggressive and when to step back. Third, sentiment opens the door to contrarian strategies. This is where it gets interesting. Extreme optimism or pessimism often signals that the market may be overextended. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This contrarian mindset allows traders to buy when fear peaks or sell when greed dominates, timing market extremes rather than simply following the crowd. So, how do you actually measure market sentiment? There's a toolkit of indicators and methods that traders use. Sentiment surveys like the AAII or Investors Intelligence Survey reveal how retail and institutional investors feel about the market. Extreme readings, very high bullishness or very high bearishness, can indicate potential turning points. The Volatility Index, or VIX, often called the fear gauge, is another key tool. When the VIX spikes, fear is high; when it's low, confidence dominates. Put-call ratios also provide insight, showing the balance between bearish puts and bullish calls. High ratios indicate bearish positioning, low ratios signal bullish positioning. Market breadth indicators, such as the advanced decline line, tell you whether most stocks are moving up or down, giving another layer of sentiment insight. Finally, news and media analysis is surprisingly powerful. Headlines, analyst commentary, and social media chatter can rapidly shift sentiment, often before technical or fundamental indicators catch up. To see all this in action, let's examine a real-world case study, the 2020 COVID-19 market crash. Early in the pandemic, fear gripped markets globally. The VIX shot above 80, signaling extreme volatility and fear, levels not seen since 2008. Investor sentiment surveys hit record bearish levels, the put/call ratio surged as traders bought puts to hedge against further declines, and the advance/decline line fell sharply as more stocks declined than advanced. News outlets amplified the uncertainty with constant coverage of economic and health crises, creating a feedback loop of fear. Traders who understood sentiment could have used this as a contrarian opportunity. By watching for extreme bearish signals and combining them with technical reversal indicators, like bullish divergence on the RSI, they could time entries into long positions. Indeed, when governments and central banks launched massive stimulus measures in April 2020, the market rebounded sharply. Traders who were prepared for a reversal were well positioned to benefit. Let's break down a step-by-step approach you could have used. First, observe sentiment extremes, high VIX, extreme bearish survey readings, weak market breadth. Second, look for technical confirmation, such as oversold conditions or bullish divergences. Third, enter cautiously, using stop-loss orders to manage risk while allowing for a potential recovery. Fourth, monitor sentiment continuously, because it can shift quickly as news and economic data come in. Here's an important point: sentiment is dynamic. Unlike a static fundamental report or a fixed technical pattern, sentiment changes daily, sometimes hourly. That means you need to combine sentiment analysis with other tools, fundamentals, technicals, and risk management, to make informed trading decisions. Now, here's a practical takeaway for you as a trader. Start tracking sentiment regularly, even if it's just a few minutes a day. Watch the VIX, check investor sentiment surveys, monitor news and social media sentiment, and notice how price reacts. Over time, you'll begin to see patterns, times when the crowd is overly fearful or overly greedy, and you'll learn to recognize opportunities that others might miss. And here's a question for you. Think back to a time when market sentiment seemed extreme, either overly bullish or bearish. Did you act on it, or did you wait? What would you do differently if you had hindsight? Share your experiences in the comments down below. I'd love to discuss them in the next episode and learn from your insights. To sum up, market sentiment is one of the most powerful tools in a trader's toolkit. It helps you identify trends, manage risk, apply contrarian strategies, and time entries and exits more effectively. The 2020 COVID-19 crash is a perfect example of how understanding sentiment can turn a market panic into a strategic opportunity. Remember, as Basso said, sentiment analysis provides a window into crowd psychology. Knowing what the majority feels can offer valuable clues for trade timing. As we wrap up Tip 30, Understanding Market Sentiment, I want you to think of sentiment not as an abstract concept, but as a living, breathing part of the market. Observe it, analyze it, and let it guide your trades alongside your fundamental and technical insights. That concludes our fundamental analysis chapter, covering tips 21 through 30. Keep applying these insights, remain disciplined, and remember that trading is as much about understanding human behavior as it is about numbers. Until next time, stay vigilant, keep learning, and trade smart.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.